Hi everybody. This is the lecture for topic number 8. Okay, this topic is about the liability and owner's equity. I hope you can still remember. In topic 6, you have learned about the accounting for current asset. In that topic, you have learned about accounting for cash, and then accounting for account receivable, and then we skip one topic, that is accounting for inventories. We will do that later. I will cover that topic in the class. And then last week I have prepared a recorded lecture for topic number 7. Topic number 7 is the topic for accounting for non-current asset. Okay, now we are doing topic number 8, which is about the liability and owner's equity. Okay, let's see. Okay, so we start with the liabilities, and I think everybody knows that liabilities can be divided into two categories: the current liabilities and the long-term liabilities. Okay, let's see the current liabilities first. So let's see the first point here. A current liability is an obligation. Obligation means something that a business has to pay. Okay, so it is an obligation that is first due within 1 year of the date of a business balance sheet. So if you see a liability has to be paid by a business within 1 year, then that liability is a current liability. Okay, that is the most important thing. The second point is a bit advanced for you. And then the next thing that you can see in this slide is current liabilities are usually presented in the following order. So this point says that you have to show the current liabilities in the balance sheet. So when you show the current liabilities in the balance sheet, you have to show it according to this order. Okay, the first thing that you have to show for current liability in the balance sheet is, see there, the principal portion of notes payable that will become due within 1 year. The principal portion of notes payable that will become due within 1 year. So notes payable is like a borrowing. So if a business has a notes payable, then that is the first thing that you have to show in the balance sheet under the current liability. But as far as I know, in Malaysia, businesses do not use notes payable, so then don't have to worry about that. So the second thing in under the current liability is, see there, the second thing is you have to show account payable. Okay, that is typical in Malaysia. A business owe money to the supplier, and the business will record that in account payable. So in the balance sheet, you have to show the account payable. After the account payable, you have to show the other current liabilities. For example, tax payable, income tax payable, if the business has to pay income tax, interest payable, and other accrued expenses. I think you have learned in class. We have covered in class things like wages payable, interest payable, tax payable. These are the things that you have to list in the balance sheet. Okay, and then see the first point in this slide. The parties who owe the current liabilities are referred to as creditors. Okay, let's see, you have a business, you owe money to somebody. The parties that you owe are called creditors. Maybe the creditors are suppliers most of the time. If the creditors have a lien on company assets, then they are known as secured creditors. So sometimes creditors ask for something. Before you are allowed to get credit, you have to the creditor will ask for something like a guarantee, and then that kind of creditor is called secured creditors. And then another creditor are called as unsecured creditors. Okay, and then see the second point in this slide is common journal entries for account payable. So here you can see how to record something in account payable. Very easy. Most of the time you record account payable because you purchase something from supplier. So if that is the situation, then you the journal entry is like the one that you can see here. You have to write the date and then debit account purchase and then credit account payable. So in accounting, when you purchase something from supplier, let's say you have a grocery shop, you purchase something from supplier, rice, sugar, or anything. So you debit account purchases and credit account payable if you want to pay later. Okay. And then when you pay the account payable, then the journal entry is like the one that you can see in the point B here. Okay, when you pay the account payable, then you have to credit account cash, because when your business pay the account payable, cash goes out. So credit account cash and debit the account payable. You have to debit the account payable because when you pay the account payable, the liability decrease. Liability decrease, you debit. So that's why you debit account payable. Okay, let's see the point C here. Let's say you purchase something from supplier in credit, and then you pay the amount earlier. Most of the time, if you pay account payable earlier, then you will get discount from the creditor. So if you get discount from the supplier or creditor, then the journal entry that you have to do can be seen in this point C. So you have to write the date and you debit the account payable because the account payable will decrease. And then you have to show the amount of the discount. That discount is called discount received. You get the discount, you receive the discount, and then you credit account cash. For example, you owe money, you owe $1,000 to a supplier, and then you pay early. You pay early, and the supplier gives you $30 discount. So how to record that? The way to record that is you debit account payable $1,000. You have to debit the account payable $1,000 because you owe $1,000 to the supplier. So you debit account payable $1,000, and then you have to show the discount. Let's say the discount is $30, so credit discount received $30 and credit cash only $970. So the total in the debit is 1,000 and the total in the credit also 1,000. Okay, one of the okay, this slide is about the long-term liabilities. Long-term liabilities are liabilities that a business has to pay in the period of 1 year or more. So one of the examples of long-term liability is the notes payable. Okay, like I said earlier, notes payable maybe it is not used in our country, in Malaysia. So I will skip this. Okay, this is the typical long-term liability, the mortgages. I think most of the time we call this as a long-term loan. Long-term loan. So let's see. So mortgages or long-term loan is a written promise to pay a stated amount of money, and it is secured by pledging of certain assets. Liability recorded on the balance sheet is the amount borrowed, which is also the present value of the future payment. Okay, let's see. Don't have to worry about the difficult explanation here, but you just, I think, have to focus on the way how to record the long-term loan or mortgages. See here the example in the white box. A company takes out a 30-year $100,000 long-term loan with monthly payments. The interest rate on the loan is 8%. The monthly payment are $733.76. So if this is the situation, how to record this transaction? Okay, when the company or the business takes the loan, then you have to do the journal entry like this, the one in the white box. You have to debit account cash $100,000 and credit the mortgage payable or long-term loan 100,000. Debit cash, credit long-term loan 100,000. I think better we use the term long-term loan. And then something that you have to know is if a business borrows a certain amount from bank, then the business has to pay back the loan or borrowing with interest. Every time the business repay the loan, the repayment will include the payment for the amount borrowed by the business. We call it principal, and also plus the interest. So see here, this business in this example borrow $100,000. Borrows $100,000, and then every month the business pays $733.76. So from this monthly payment, the payment for the principal is only the payment for the interest is $600 and $66 in the first month, $666.67. And and the payment for the principal is only $67.09. So this will happen. At the personal level, if in the future you make a bank loan, personal bank loan, or you make a bank loan to purchase a house or car, this is the thing that you have, you will see. When you pay back the loan, you will pay for the interest, and also at the same time you will pay for the principal. Okay, so most of the time at the earlier part of the repayment, most of the payment is for the interest, and after that the payment for the interest will decrease and the payment for the principal will increase. So just see this example. See here, this one is payment 1, 2, 3, 4, 5, 6. Okay, so now how to record this repayment? In slide number 6, I think you have seen how to record when the business do the borrowing. So the business got $100,000, so you debit account cash, credit account bank loan. So now when the business repay the loan, this is the way to do the journal entry. For example here, let's say you want to record the repayment of the loan for the month, for the 5th month. So see the schedule. In the 5th month, the payment is $733.76. So that is the amount of the payment. When that is the amount for the payment, so that is the amount of the cash out. So when you want to record this repayment, you have to credit account cash $733.76. That is the amount of cash out. So that's why you credit account cash $733.76. And then remember, when you repay the loan, when the business repay the loan, two things will happen at one time. Some of the payment is for the interest of the loan. So interest is an expense. If you have a business, and then you have to pay interest for your bank loan, that interest is an expense. So remember, expense increase, you have to debit. So that's why you can see in the white box at the bottom of this slide, you have to debit account interest expense. Okay, debit account interest expense. You have to refer to the schedule there. The interest amount is $664.86. And then you debit account mortgage payable, or the account for bank loan. That is the liability. Liability decrease by $68.90. Always remember, when a business pay back a bank loan, there will be a cash out, and then that cash out is for the payment of interest expense and the liability, the bank loan. Okay, the second thing that you have to know, I think related to the long-term liability, is the lease. I think we have discussed lease in the previous topic. Remember, you have learned about lease in the topic number 7, accounting for non-current asset. So capital lease, remember capital lease, we have discussed about that. Capital lease is a business lease something, lease an asset, but at the end of the lease agreement, the business will own the asset. So remember, when a business do a capital lease, the asset has to be recorded as a non-current asset, and then the amount of the lease has to be recorded as a liability. So here you can see again. So for example here, a business lease equipment for 10,000 a year, discounted at 14%. So you have to record the equipment like the business own the equipment. So you have to debit the lease equipment and then credit lease liability. So every time the business do the lease payment, you have to record like the one that you can see in the white box there. Here in this slide, record interest expense and first 10,000 payment. So you have to show the cash out. So credit account cash 10,000, and then you have to calculate the interest expense 73303, and then the lease liability is 2697. How to calculate the interest expense? 14% times the lease liability. Okay, so just remember about this. Later, if I have a sample question, then I will discuss it in the class. Okay, that's the thing about the liabilities. Just to refresh your memory, I think I hope you can remember the first thing that you have learned about the accounting for liability is the current liabilities. So current liabilities are liabilities that a business has to pay within 1 year. Okay, so most of the time in the current liability that you always see is the account payable. If you have a business, you purchase something from supplier in credit, then you have to record that in account payable. Okay, remember how to do the recording. And then there are other current liabilities like wages payable, tax payable, I think rent payable, things like that. Okay, and then you have learned about the long-term liability. Long-term liability, the most important one is how to record the long-term loan. The term used in this slide is mortgages. So how to record when a business borrow money from a bank? So you have to debit the bank the cash and credit the bank loan. And then how to record the repayment of the loan? You have to credit account cash and then debit the interest expense and also debit the long-term loan. Okay, and then you have seen long-term liability for capital lease. How to record the capital lease and then how to record the lease payment. Okay, now let's see the second part of this topic is accounting for equity. Remember what is equity? Equity is the amount owned by the owner of the business in the business. Let's say you have you open a grocery shop. then the amount that you put into the business, for example, you put $20,000 cash when you start the business, that amount is called the owner equity, the amount owned by you in the business. The equity can be in the form of cash or other asset. Maybe you put furniture, you put motor vehicle in the business. That are also called equity, the amount owned by the owner of the business in the business. Okay, what is the difference between liability and equity? Both liability and equities are used by a business to purchase asset. To purchase asset or to acquire asset. If you have a business, you get asset for your business by using liabilities or equity. Okay. So the difference is liability is something that a business has to pay back. When a business borrows something from bank or other parties, the business has to pay back. But equity is something that the business something that is not compulsory for the business to pay back. Let's say you have a grocery shop. If your grocery shop borrow money from bank, that is a liability because your grocery shop has to pay back the borrowing. But if your business get cash from you, the owner of the business, then the business does not have to pay back. Is it? There is not compulsory for the business to pay you back because you invested. That is the owner's equity. Okay, so now the focus is on the sole proprietorship, because in this course you are learning about how to do accounting record for a sole proprietorship, for a business owned by one person. That's why I always made example you own a business, because you are learning about accounting for a sole proprietorship. So for a company, remember, I hope you still remember the definition of a company. A company is a big business owned by shareholders. So for a company, the equity or the capital is related to the shares. A company is a business owned by the shareholders. So shareholders put cash into the company, invested cash into the company. So that investment is called shares. A company is owned by shareholders. So the amount invested by shareholders into the business is recorded as shares. Okay, don't have to worry about that. Your focus is on this one. Your focus is on the on sole proprietorship. Okay, so for a sole proprietorship, let's say you start a business, you start a grocery shop. So that is a sole proprietorship business, a business owned by one person, owned by you only. So the amount you invested into the business, the cash that you put into the business, is recorded or has to be recorded in account capital. You have done this before. So see here, these are the common journal entries for owner's equity for a sole proprietorship business. So every time the owner of a business contributed cash into the business, then you have to record it like the point A here. If the owner of the business invested cash into the business, you debit, you write the date and then debit account cash because asset cash has increased, and then credit account capital. Let's say the owner of the business invested other asset. For example, you have a business and then you take your personal computer from home, you put into your grocery shop. You use the personal computer to manage your grocery shop. So how to record that? So when you put an asset, including the personal computer in your business, then that is also has to be recorded as an increase in capital. So if that is the situation, then you have to debit equipment, personal computer, and then credit account capital. So the owner of a business can invest cash or other asset in the business. Okay, B. An owner of a business also can take something from the business. For example, you have a business, a grocery shop. One day you take $100 cash from the business. It is possible. So in accounting, we record that as a drawing. Okay, so how to record that? So see here in the point B here, you have to write the date and then debit account drawing. Our example is $100, and then credit account cash $100. If you take other asset, for example, you have a grocery shop, and then one day you take 2 bags of rice. So the value of this rice is $50. Okay, so how to record that? If a business owner take other asset from the business, you have also to record it as a drawing, not only cash. If the owner of the business take rice, for example, then for a grocery shop, the rice is the inventory. So you have to record it like this: debit account drawing $50 and credit account inventory $50 if the owner of the business take the inventory. Okay, I'm sure I will do or share with you several sample questions related to accounting for liabilities and equity. So I think this is not difficult for you to understand and to do. Okay, thank you very much. Do not forget to write your name and metric number in the comment section of this video. I will record that as your lecture attendance. Thank you very much.